be good. Okay. Takes a while to get organized, but it's getting better. Although it was swelling, so I talked to them. They said you're standing too much. So, all right. Okay. Let me. First of all, I did bring in, and again, you've met my daughter here, who's another professor in classics. So I did bring in the album of the week is Humble Pie, okay, Rockin' the Fillmore. Great band. How many have ever heard of the Fillmore? Really, that's all? Okay, the Fillmore is a famous location in San Francisco. My roommate and I actually went to see Humble Pie at the Fillmore. So, but anyway, this is a great album. So it's a double album, you might just take a look at Stone Cold Fever is probably the big song that came out of this. So anyway, I would recommend Humble Pie, Rockin' the Fillmore. Okay, so basically we finished the sort of the theoretical part of the income tax, right? So what we did was again, you look at the trade-off, you have to pick two things. So we said if you're going to tax wages, then you got to look at the trade-off between leisure and income, and we could make a substitution income effect. And then when we looked at a tax on interest, we looked at the trade-off between current consumption and future consumption. Again, you can move the budget line, take the new budget line, make it tangent to the old indifference curve. That gives you the substitution effect, and then the income effect is the difference between that and where you end up. And we noted that consumption is probably certainly a normal good if you're looking at the total amount of consumption. And so the substitution effect and the income effect is going to work in opposite directions. And we also noted that it's possible that current consumption is a normal good. And so then again, they'll move in opposite directions. Again, just to be careful that when we were doing the substitution income effects, when we were looking at the good itself, like taxing a particular good, like a sales tax, we were moving the budget line along the x-axis, and then this time we're moving it along the y-axis. So what we're going to just do today is to just take a look at how the actual income tax works. And I put in the folder all the forms for the 2020. They're also in there for the 2018, et cetera. But you might take a look at the 2020 forms, and you can look at the 1040 and start working your way through. And I'm just going to go over that a little bit now and just have a few comments. First of all, if you look at the 1040 and you start working your way through, you see that the taxes, again, remember that we talked about the Haig-Simons comprehensive income tax base, right? So this isn't going to be a comprehensive income tax base. Some things are going to be taxed, some things are going to be taxed at a different rate, some things are not going to be taxed. So you're going to have deductions and credits, so it's not going to look exactly even close to the Haig-Simons. But first of all, the main obvious thing that you'll see when you look through the 1040 is wage and salary income, right? So I'll get a W-2 from the college, and it'll tell me, they'll tell the Internal Revenue Service what my wages were, so they'll know, right? So if I'm filling out my income tax form, they'll be able to figure that out. Then taxable interest, right? There's some interest that's taxable and some interest that's not. And the Schedule B, if you look at the Schedule B form, you'll see that the taxable interest is listed there. You'll see, what interest is taxable and what interest is not. For example, just as an aside, you don't have to pay taxes on interest that you pay for mortgages, okay? And again, we'll talk about that in a moment, is that will affect what the cost of of housing is relative to rental housings, right? So it affects behavior. Dividends also are taxable, and what they call ordinary dividends. And so again, if you look through, you can see the dividends are from your earnings from your, let's say you have GameStop stock, and it pays a dividend. Then that dividend shows up, and whoever is your the company that you're holding the stock with, let's say Charles Schwab or whatever, they'll send you a statement that says, here's how much your dividends were. Some IRA deductions are. Again, we'll talk about it in a moment, but you have what's called a regular IRA, which was put in order to encourage people to save. And what that is you put money into this account, and that money is not taxable going in, but it is taxable coming out. But any of the capital gains that happens are not taxable. So if you bought GameStop stock for $100 and then it's $300, you don't pay any capital gains on that. What you pay the income tax on is when you start pulling money out. So you sell the GameStop stock and you take some of that money out of the IRA, that's what gets taxable. There's a thing called a Roth IRA, which got put in a number of years ago, and that goes in taxable. That is, you don't get to deduct money that you put into the Roth IRA from your income. But when you take the money out of the Roth IRA, it's not taxable. So again, you're avoiding capital gains and dividend taxes along the way with that. Some pensions are taxable, and it's sort of, again, there's all sorts of rules on this thing, and sort of one of the main things to get out of the income tax is that it's really complicated, okay? Which is why they have accountants, and why H&R Block has got their spot here, and Steve, your accounting, and one of the, up in Jonesville, there's Greg Bailey's accounting office. I happen to know him because he's in Rotary. So anyway, there's all sorts of people out there that do that. And why is that demand? If it was really easy for you to do, you'd probably do it. Now, some Social Security benefits are taxable. Some aren't. It depends on what your income is. If your income is above a certain threshold, then you have to pay taxes on your Social Security. Capital gains are taxed at a different rate. And then the way capital gains get included is you'll see that it'll say Schedule D. So that if you sold your GameStop stock and you held it for more than a year, then it's not taxable as regular income, it's taxed as a capital gain, and that's taxed at a lower rate. Sometimes you hear people say that Warren Buffett doesn't pay as many taxes as his secretary. And that's because his secretary is earning wage and salary income, and most of his income is coming about from capital gains that he's earned on stock that they sold. And that's taxed at a lower marginal rate. They tried to make the form look, the 1040 form look less difficult. So what they did is they attached all sorts of schedules to it instead. So if you look at other income, used to be on the 1040, but now it'll just say other income. But that means you put in your Schedule 1. So again, if you look at the Schedule 1, you can look through that and it's got all sorts of other income. For example, alimony income. Income from your business. And that requires you to fill out a Schedule C. So if you look at your Schedule C on the form, you'll see how business income is treated. So for example, I sometimes get paid to give a talk by somebody, or I might get paid to write a paper for somebody. And if I do, then that is income to me as a business. I'm not an employee of the company that hires me to go out and give a talk, okay? So what I have to do is I have to declare that I have a business, Gary Wolfram, and then I have to fill out the Schedule C that says, here's how much my, business earned. And so I get to deduct certain things, there's certain expenses, let's say maybe some of the money that I spend for my cell phone, because I have to have a cell phone in order to have my business, etc. So again, you can look through the Schedule C and take a look at all the different things that are included as income and things that are deductions. If you have a rental house, which I did for a number of years, and if you have a rental house, or if you have rental income, or if you have an S corporation, which is a company that is formed where the company itself doesn't pay the taxes get moved to whoever are the owners of the S corporation. So for example, I had an S corporation. In fact, I still have an S corporation. It's called Hillsdale Policy Group. And so if I do something where somebody wants to pay Hillsdale Policy Group instead of me, then what happens is Hillsdale Policy Group by March 15th files basically the equivalent of the 1040 with the state, and that income that Hillsdale Policy Group makes isn't taxed to Hillsdale Policy Group. It then moves to my wife and I, who are the sole owners of Hillsdale Policy Group. There are how many have ever heard of LLCs, limited liability corporations? Yeah, same deal, right? Limited liability corporations, S corporations. The reason that you form those is because of the liability. Like if you were to get sued, they would sue Hillsdale Policy Group, and Hillsdale Policy Group doesn't have very much money, okay? And so limited liability corporations are really there to protect you as in terms of the liability that you might have. But the income then just transfers over to you. Partnerships, real estate, how many law firms are generally a partnership? So law firms work that way. It's a partnership so that the money earned by Sam Bernstein, I don't know if you've ever seen the television ads for Sam Bernstein, Michigan's family of law or whatever, okay? Sam Bernstein, that firm earns income, but Sam Bernstein law firm probably is a partnership, which means it doesn't pay the taxes. The taxes of the Bernstein law firm get assigned to all the different partners, and they end up paying the tax. So that's on the Schedule E. So if you look at the Schedule E, it will give you some more information on how that gets taxed. Unemployment compensation, that's taxable. So, and of course, you've probably been following this, but with the coronavirus, there's been all sorts of issues with the unemployment compensation, extending it beyond what it normally is, an extra $600 per person, et cetera, da-da-da-da. Well, that's all then when you fill out your income tax at the end of the year, everybody's going to have to put on the income tax form what their unemployment compensation. Then, so that gives you what your income is, okay? Then there are adjustments to income, and that is Schedule 1. So if you look through Schedule 1, you'll get to see what the adjustments to income, and there's a whole slew of this. For example, educator expenses. If you're a teacher, you can deduct certain expenses that you have. There's a health savings account deduction. So if you put money into a health savings account, which is another entity where that grows without being taxable, that health savings account is you deduct that when you can deduct that and when you make payments into this health savings account, for which you can only use certain medical expenses. Remember that we talked about self-employed person tax, right? That's what the payroll tax. If you for example, any company that hires me to write a paper, they don't pay the payroll tax. I have to pay the payroll tax. So I pay the whole 12.4% of the Social Security tax, for example, and I pay the Medicare tax. Then what happens is I get to deduct that tax that I paid from my income as I get down to adjusted gross income. Certain IRA deductions get deducted from your income, and then there's a student loan. I don't know if any of you have a student loan, but if you do happen to have a student loan, that is an adjustment to your income, so it comes off of there. So that gets you to your adjusted gross income, okay? Now, one of the aspects of that it used to be called above the line. That was sort of the slang for whether there was a deduction that you could take after you get to adjusted gross income, or whether it was an adjustment to income. The advantage of an adjustment to income is it comes straight out of your taxable income, okay? If you have a deduction, which we'll get to in a moment, if you have a deduction, then that only is a benefit depending on what your marginal tax rate is. Whereas if you have a 37% marginal tax rate, if you get to deduct it, then that value of that deduction is only 37 cents in terms of reducing what your taxable income is. Whereas if I get to deduct it above the line, it comes off of my income in total. So you'd like to have, if you have high marginal tax rates, you'd like to have it as an adjustment to income rather than have it as a deduction. Okay, so that takes you down to the deductions. So then you have either a standard deduction, which means everybody gets that. And we'll talk about this in a moment, but the tax reform that the Trump administration put in drastically increased the standard deduction. So currently in 2020, the standard deduction for you as an individual is $12,400. Now what that means is if all the things that you can itemize your deductions come up to less than $12,400, forget it. Right? You're going to take the standard deduction. If you're married, and filing jointly, it's double that, $24,800. So when I'm filling out my income tax, I'm going to look up all my deductions, and if they don't come up to $24,800, forget it. I just take the standard deduction. So if you look at the where you fill out your scheduled deductions, that's under Schedule A. Now, under Schedule A, if you look at what things you can itemize, big thing is medical expenses, okay? Medical expenses, but they have to exceed 7.5% of your adjusted gross income that you already calculated. So if you had medical expenses that were 5% of your adjusted gross income, not deductible. Only that portion that's in excess of 7.5% of your adjusted gross income is deductible. Interestingly, state and local taxes are also deductible. Now, if you have you can either pick income or sales. You can't do the state income and the sales. So for state taxes, income or sales which exceed $10,000, and you can deduct property taxes, local property taxes, or if the state has a property tax, you can deduct that. And that, again, though the taxes have to exceed $10,000 before you can deduct them. Just like the medical expenses over 7.5% of your adjusted gross income, boom, that's deductible. The taxes that exceed 10%, or excuse me, exceed $10,000 is deductible. that leads us to home mortgage. Then you have, if you take a look, you can deduct interest on your home mortgage. You can also deduct interest on your insurance premiums for your house. Notice that you don't get to deduct your rent. So what does that do, right? That is an incentive for people to buy housing, right? I mean, that's again, and we'll come back to that in a moment. Gifts to charity, those are deductible. In fact, under the recent movement change in the tax code allows you to, I think it's $300 that you can deduct in charity above the standard deduction. So there's an extra little amount to encourage people to give to homeless shelters and all that stuff during the coronavirus. So if you look at the 1040, you'll see that you can give an extra $300 in charitable deductions above the standard deduction. You can deduct casualty and theft losses. So if you were living in California and your house burnt down, then you can deduct that, right? Or if someone steals your car, then you can deduct that. Now, of course, if that's the amount that's beyond what the insurance paid for, right? So you don't get to deduct, the $10,000 that your car got damaged, and then you also collect the $10,000 from the insurance company. All right. So again, just as in the book, they go over these sorts of things. Just I'm not going to ask you on the exam to tell me what the different deductions are, but you should be able to recognize that something is deductible or not, right? So you should be able to recognize the right answer. But that leads me to talk about just some observations on this. First of all, as we noted, the income tax is very complicated, right? And when we were looking at what Adam Smith was talking about, when he was talking about administrative efficiency, right, versus equity, if it's very costly for you to comply, if you have to spend a bunch of money or a bunch of your time figuring out what the tax is, then that is an efficiency loss. And so one of the complications of both the regular income tax, and we'll talk about it when we talk about the corporate income tax, is going to be that there's a substantial efficiency cost. Notice that the second major thing is that these things influence behavior, right? So if I give a deduction for college expenses, what does that do? It makes it less costly for you to go to college. So what did that do? That lowered the price of going to college. What does that do? It gets you to buy more college than you otherwise would have. So that is going to have an excess burden, right? I've made college less expensive, so there's going to be a substitution effect, okay? And an income effect. And if college is a normal good, right, they'll move in the same direction. But in terms of an excess burden, you will have moved people's behavior. On the other hand, it may deal with horizontal equity. Why do we make it so that we have a child care credit? In fact, did I? Yeah, I forgot to mention the credits, right? I didn't mention the credits yet, did I? Okay. Let's skip down here. So basically, also, if you look at the 1040, you'll see that you get credits for things. And in particular, you get credits for the big ones are the earned income credit, the child tax credit. There's an American Opportunity Tax Credit, which you guys might want to know about because it's for qualified expenses for higher education expenditures. So if you're filling out your own income tax form, notice that this is not a deduction. This is a credit. So even if you have the standard deduction, you get to what your taxable income is, then you look through and you get credits for these sorts of things. So if you had $300 in the American Opportunity Tax Credit, then that comes off of what your taxes have to be. So credits are an advantage in that they reduce your taxes dollar for dollar. There's also, again, another schedule. If you look at Schedule 3, it'll give you other credits that you can take. For example, there's credits for child care expenses, and there's health coverage tax credits. And with regard to a credit, there's two types of credits. One is it's not refundable. Okay? If your taxes are $10 and you have $30 in your American Opportunity Tax Credit, then you only get the $10. Okay? But some taxes are refundable in that you get some of the credit, maybe the whole amount of it, back to you even if you don't pay taxes. And I believe that I have to look it up, but I believe the American Opportunity Tax Credit, a portion of that is a refundable credit. Anyway, you can take a look at the 1040 and the Schedule 3 to take a look at those. But so credits are another thing that affects people's behavior. Now, that may be an equity issue. That is, I got two people with the same income. One has 6 kids and the other has no kids, right? So I've got this family, both earned $40,000 this year. I got one with 6 kids and one with no kids. How do we make horizontal equity, right? We might say, hey, the person with the 6 kids has a lot more expenses than the person without kids, and so we should do something to provide a credit in order to provide for horizontal equity. So these credits are there to, A, influence people's behavior, or they're there to provide for horizontal equity. Again, it makes it more and more complicated as we start to think through, okay, why should we have this credit? Why should we have these deductions, et cetera? Why should some things be credits and some things be deductions? Okay, that, you know, again, a credit is going to give you more off your taxes than a deduction would be. And so, again, at the end, you get to an alternative minimum tax. Now, the alternative minimum tax is to make sure that some people don't have really good accountants and figure out that they don't have to pay any taxes. You still have to pay a minimum tax after you've figured out all your taxes, right? You spend your time and you figured out all these taxes. You also have to figure out an alternative minimum tax and see if this alternative minimum tax is higher than the taxes that you figured out after going through all your credits and all your deductions. Then you still have to pay this alternative minimum tax. And what is that about? This is about some sort of equity issue, right? I don't want to make it so that some people are really rich and they have really good accountants and they know how to do all this stuff, and you guys are out there just, you know, buying your H&R Block $24, you know, tax form, or you're getting some of them are free. I don't know if you get, sometimes you get emails that you know, Intuit or whatever, you can get a free tax. And I don't know how they make money doing that. But anyway, bottom line is you may just be doing the cheap way of doing it, and it turns out that that it's not fair in that sense. And so this alternative minimum tax is sitting out there as sort of a fairness issue. All right. Again, there's a creation of an excess burden when we are using the tax code in order to alter people's behaviors. And in particular, it's interesting is this the mortgage interest and the deduction for your insurance premiums. Because again, you don't get to deduct your rent. So what that does is it makes rental housing more expensive relative to home ownership. What's that going to do? Have people buy more home ownership. So your tax code is out there creating an excess burden. Why would you do that? Well, if there's something where you think that it's better for society, let's say you are the chairman of the Senate Finance Committee, and you think that it's better for people to own houses. You say, well, most people's wealth, actually if you look at data, you'll see that a significant proportion of people's wealth is in their home relative to their stocks. Again, that's sort of biased because you may not own stock, but you may have a pension. You may be with the Michigan Education Association, right? So it might be a unionized teacher, in which case you're getting a pension from the when you're working, you're going to define benefit, right? So how does that pension growing, right? That pension money is put into stocks. So indirectly, you own stock, even though you don't personally own stock. The pension is going to be in the stock. But if you are chairman of the Senate Finance Committee and you say, well, it's just better for people to own houses, I think that's what we ought to be doing, is encouraging people to do that, and you use the tax code to do that, okay? And so you're making this trade-off where you're saying, okay, there's some excess burden here, but I think this excess burden is worth paying because it's just better for society to have that. Another observation is that the higher your marginal tax rate, the greater the effect, right? If your marginal tax rate is 10% and I give you a deduction for mortgage interest paid, then that's only worth 10 cents on the dollar. Whereas if your marginal tax rate's 37%, then it's worth 37 cents on the dollar. So if you're looking at, okay, I'm going to give a deduction for home mortgage paid, you'd think that if you said, hey, and I want it to work for low-income people more, what should you do? Put it in as a refundable credit, right? If you put it in as a deduction, then what you're doing is that you're giving the benefit to the people, a greater benefit to people with higher incomes because they have a higher marginal tax rate. What that means is there's a political bias to how these things get stuck in the get stuck into the tax code. Why is something included in the tax code? Probably a political bias. So, for example, if you are the banks that make mortgages, what should your lobbyists do? Your lobbyists should be in there getting a deduction for mortgage interest paid, right? If you are a state and local government, again, if you've been following all this debate on in the Biden tax proposal, what were the Republicans saying? Republicans were saying, you know what you're doing is if you give a deduction or you give money to state and local governments, you're sort of bailing out the blue states, the Illinois of the world that have set themselves up with these high pension liabilities, et cetera, okay? But if you look at it from this perspective, what are you doing? You're making it less costly for the state of New York to increase their state income tax, right? You're making it less costly for the city of New York to increase its property tax because you're allowing a deduction on the federal income tax for state and local taxes that are paid. So if you just look through the deductions and credits, just look through those things and the adjustments to income, right? Look through those things, you'll notice that, yeah, probably a bunch of these things are in there because of the political bias. So if you, again, when you take Econ 415, right, that's one of the things that we talk about is we talk about in public choice, we talk about, what are the incentives from an economic perspective to make changes to the political system. Well, that means if we think overall and we look at what an efficient tax would be, an efficient tax would have a very broad base and a low rate, right? If I can collect if I'm going to collect $3 trillion, okay, if that's the amount of revenue I'm going to collect, I could have the Haig-Simons comprehensive tax base, which is a really large base. To collect the $3 trillion, I'll have a low marginal rate, okay? So if I was looking for a tax that is an efficient tax, I'd want taxes that are broad-based and therefore have low rates. Now, notice what we have. We have lots of deductions and lots of credits and exemptions, et cetera, right? And so that's going to be a less efficient tax. Again, there's this trade-off that we talked about all along between efficiency and equity, okay? But if you look back to, and I have this on the syllabus, if you look at a book by Hall and Rabushka called The Flat Tax that they wrote in 1983, that was their insight, was that you'd be better off with, why is it called a flat tax? It's because there's no deductions. There's no credits. All it is a flat tax. And and it has a constant marginal tax rate, okay? And if you included that with the Milton Friedman idea of a negative income tax, where there's a deduction an exemption that everybody has, and then it goes along the marginal tax rate is constant, you'll still have it be progressive. But what they argued for in 1983 is this flat tax, and so you would have a very broad-based tax, and so you could collect the same amount of revenue with a lower marginal tax rate. So 2017, what did we do? When we vastly increased the standard deduction, you made it look more like the flat tax, right? Because all those deductions that I'm looking at are gone, right? For you guys are, I don't know how charitable you are, but you guys probably aren't going to give $12,400 away to charity this year, okay? So you guys are probably just going to hit the standard deduction, which means, boom, it looks more like the flat tax. So the big increase in the standard deduction that was happened in 2017, if you think of it from this perspective, that should have made the tax more efficient, and it would require a less expenses from your perspective in trying to figure out where everything. You guys don't have to keep track of your medical expenses, right? You don't have to keep track of your charitable donations, all that stuff, because you're not going to hit what the standard deductions are. And then a last point that the authors make in chapter 14 is, again, the things that we talked about as major exclusions from Haig-Simons. For example, we talked about implied rent, right? That is, again, a bias towards home ownership, in that if I rent my house to you, then I got to pay taxes on the rental income that you pay me. Whereas I don't have to pay taxes on the implied rent that I get from owning my own house. So these, we talked about these, all these non-market transactions. How do you actually deal with that, right? So that's a problem in trying to implement an actual income tax. Again, fringe benefits. Another thing that that the authors are pointing out, that if you look at what's going on in the what's going on when you're looking at the actual implementation of an income tax, that is, fringe benefits aren't being taxed, right? So again, hardly anybody's been in my office, okay? My daughter noticed that when she was in my office that I have all sorts of things, including I think I've told you, a Clint Eastwood photo, that poster that she gave me from the Italian version of one of his movies. So I got all sorts of cool things in there. Of course, none of which the college actually put in there, so I guess that's not a good example. But suppose that the college, gave me a Van Gogh and let it, so I could put that up there, although I don't think I would have room to put it in there. But the bottom line is that yeah, she'd make room. But the bottom line is, if I were the CEO of Johnson & Johnson, I would probably have a really cool office and have all these things, and I have a limo driver and all these other fringe benefits that don't get picked up. Interest on, again, one of the things they point out, as we've just talked about, is that interest on state and local bonds is not taxable. What does that do? It makes it so that it makes it less expensive for the state of New York to issue bonds. It makes it less expensive for the state of Illinois to issue bonds, because if I buy that bond, right, I don't have to pay taxes on that interest. And then again, they talk a little bit about all the different, not explicit about this, but all these IRAs. And again, the IRAs were put in relatively recently, relatively recently within my lifetime, probably not within your lifetime, but what was that to do? That was, again, to encourage people to save, right? Partly because, is Social Security going to be around for you guys, right? We already talked about that, right? It may be that Social Security is never going to be around for you guys, okay? Because you'll have all spent it all to give me my Social Security. Okay? So the IRAs that are out there were to get you to put money into a savings account itself. But there's what's called a 403B. There is a 401k. What that is the 403B is what the college has, because it's a nonprofit. So when the college can take a certain amount of can add to my income, they can give me an extra, let's say, $5,000 this year, and it goes into this, basically this IRA sort of thing, which is a savings account that when I take money out, it's taxable to me as it comes out, but it's not taxable going in. Just like we were talking about a regular IRA, money not taxable going in, taxable coming out. If you work for a firm, it's probably called a 401k. So if you get a job with let's say you get a job with General Motors, they will probably have a 401k program where they give you a certain amount, a certain percentage of your income or your wages. They'll put into a 401k, and that is not taxable as income to you. But it's deductible. It's deductible to them. And then I mentioned the regular IRA and the Roth IRAs. All right. So that's all we're going to do for the exam. Okay. Again, I will not have an essay question on this chapter, but you should recognize or be able to recognize the right answer on that. If there's any sort of essay type question, it'll be something that we already what we've just been talking about, right? There's an excess burden for doing this, or et cetera, okay? Review session, again, Sunday. Yours is 6 to 7:30 in here. I will, I don't know if I'm going to be able to get around to this, but I'm going to, you've already got essay questions. You know, you've got the old exams, and I have some sample essay questions. You're not going to be surprised when you walk in there. But just like the first exam, you're going to have to be quick, come in with the answers sort of on your head. So know how to do substitution and income effect of tax on interest. Okay? All right? Okay. Again, office hours, probably not have office hours today. Probably not have office hours today. And you can call me if you want on my cell. Do you guys have my cell phone? Okay. Anyway, if you want, send me an email. That's the best thing. Send me an email if you have something, and we can talk over the phone if we need to. All right.